Hello there. Hello there. Can I start off by saying either a good morning or good afternoon or even a good evening, depending on where you are around the world. And thank you for joining me tonight on my latest episode of How I Got to Understand Trading series, exclusively for Stratton Markets. Today's episode is called How I Got to Understand the Different Currency Crosses. Written by myself, of course, this is James Trescothick, and I'm the Chief Trading Educator here at Stratton Markets. Now, before we get on to tonight's agenda and a brief introduction on myself, of course, we're talking about online trading and CFD trading. And like with all types of investments, it does indeed carry a great deal of risk. So I do suggest you do your own research and your own due diligence and know the risks at hand before entering any trade. With that out of the way, this hairy, wrinkly, sort of pot-belly type individual is myself. Like I said, my name is James Trescothick, and I'm the Chief Trading Educator here at Stratton Markets. I have over 20 years experience in the financial service industry. In fact, I actually started off at the age of 18. I'm now 40, not 50 like some people say, but 40. I actually started off as a mortgage broker, specializing in commercial mortgages and buy-to-let mortgages before moving into pensions and alternative investments. I then got into online trading around about 15 years ago. And I do trade, and I have traded for several prop companies, including Dubai Gold and Commodity Exchange, through Dubai Gold and Commodity Exchange. I've also ran a floor at the Philippine Stock Exchange before moving into portfolio management, and then, of course, education. So I have a really great grounded level of experience in this arena. I'm indeed a published writer. I've been published in several leading industry publications, including the likes of the Financial Times Advisor, Market Watch, which is the Wall Street Journal, several other newspapers and magazines in the industry. I'm an avid market commentator. I'm extremely passionate about this marketplace, very passionate indeed. And I'm a well-known public speaker, and I've spoken at several events around the world, including the likes of Singapore, Hong Kong, Dubai, Kuwait, Qatar, quite a few. I've been around the world. Let's put it that way. And like I say, the wrinkles on my face is not the age, it's the mileage. Anyway, that's enough about me. Tonight, we are going to be talking a little bit about currency crosses. So I'll talk a little brief history of currency exchange. Then I'll do an introduction to currency crosses, what they are. Then I'll discuss the majors and commodity currencies. Then I'll discuss the minors. And I'll talk a little bit about the dangers of trading currency crosses. But I also talk about the Japanese yen crosses, and obviously how you can sort of use the crosses to read the majors and understand why the majors are moving in certain ways because of the crosses. And of course, we'll do my usual question and answer session at the end. So if there's any questions, please feel free to ask me at the end of this session. So, what's this all about then? Well, back in the day, when an individual wanted to exchange their currency into another currency, what they first had to do is convert it into US dollars, because the US dollars is the world's base currency, and then convert those dollars into their currency they wanted. So say, for example, I wanted to go to South America or Mexico, I want to get pesos, and if I was in the UK, I would have to take my sterling, convert it into dollars and dollars into pesos, you see. That would obviously be quite expensive. Now, currency cross pairs are calculated. You don't have to do this because obviously the system will do it for you. But this is how you calculate like a currency cross pair. Again, it's all really linked to the US dollar. So let's take an example. We have the Euro Japanese yen. To calculate the ask or the bid price on the Euro yen, we first take the Euro US dollar and the US dollar Japanese yen, because we're looking at the Euro and the yen. And this is how we would calculate it. We get the ask of the Euro dollar times the US dollar Japanese yen ask. So take the asking price of the Euro dollar, times it by the dollar Japanese yen asking price, and that would give us the ask of the Euro yen. For the bid, we would take the Euro dollar US dollar bid times it by the dollar Japanese yen bid, and that would give us the euro Japanese yen bid as well. So as you can see, it's all really linked to the US dollar. But like I say, that's how you would calculate it. Like I say, you don't have to do it because it's already done for you. Now, more than about 80% of forex transactions are all in the US dollar. This is why, like I say, it's heavily linked to the US dollar. And this is due to the fact that the US dollar is the world's biggest reserve currency, as most commodities, energies, oil, wheat, etc., is all priced in dollars. So if you had to purchase oil, we'd obviously convert it into dollars. Okay. Now, this is why, to save costs, nations in general hold a massive reserve of US dollars. Okay, so it saves them changing their own currency into dollars every time they need to buy commodities. They keep their own reserve to do it. And this is why, like I say, the majors are always or mostly all linked to the US dollar. And these are some of the major currency pairs: the euro dollar, obviously, which I've already talked about, the British pound, US dollar, the cable, the dollar Japanese yen, and the dollar Swiss franc, just to give you just a few. As well as the majors, you've got the commodity pairs, okay, like the Aussie dollar, US dollar, the dollar Canadian dollar, and the Kiwi dollar, US dollar. These are majors, but they're known as commodity pairs. But then when we switch to currency crosses, we're really talking about the minors here. These include the likes of the euro sterling, the euro Aussie dollar, British pound Japanese yen, the Swiss franc Japanese yen, the euro Japanese yen, the Kiwi Japanese yen, and the British pound Canadian dollar. Now, I like looking at currency crosses for several reasons. It gives you great opportunities. It opens your mind to other opportunities instead of just simply being stuck and looking at the dollar majors. But there is dangers, of course, when it comes to currency crosses. And these include the likes of, well, the main problem is because the majors dominate the market, there's very little liquidity, or can be very little liquidity when it comes to currency crosses, because less people are trading them. And the danger then you have with these pairs is that because there's a lack of liquidity, they are prone, or they are vulnerable to sudden spikes in volatility, which can be extremely vicious. And here's an example for you. Okay, this is a dollar, euro, US dollar. Okay, and this is the euro, Japanese yen. These two tend to sort of be very heavily correlated in a positive way, so they tend to follow each other. But what you would notice is the movements. If I get my little laser pen, the movements. Though we've got the euro dollar, this is on a 30-minute chart. Though it's quite vicious, if you compare the sudden spikes you get with the euro yen, they're a lot more vicious. So this is why trading the crosses can indeed be quite dangerous. So this is also at the same time why, of course, your risk management program should really be in place. Now, despite that, I do like to say, try to be open-minded, because I tend to feel that if you limit yourself to one sort of opportunity, you're then missing out on other opportunities. And currency crosses can open you up to potential other opportunities. But you need to sort of be open-minded and understand why certain things happen and why they move. For example, okay, economic data. We have a financial calendar which is packed full of events. Okay, packed full of events. Now, the key impulse, of course, of every trader is to look at the major currency pairs first, which makes sense because they're more liquid and the spreads are cheaper. But by limiting yourself to that, you are missing out on other areas of interest. So let me give you an example. Say, for example, New Zealand. The New Zealand Central Bank decides to raise interest rates. Okay, first choice, of course, is for everybody to look at the New Zealand US dollar. Makes sense. However, say the US economy is performing strong. The movement in that case, even though the Kiwis, I'd say, raised interest rates, as the dollar is performing strong, the movement on the New Zealand dollar against US dollar could indeed be limited. However, if the economy of Japan is struggling, the moves of the Kiwi against the Japanese yen could indeed be bigger. So again, opening your mind up and looking at the crosses can give you maybe an opportunity to capture a bigger movement. Now, this is an example of Japanese yen cross, and this is why something we need to always monitor. And this happened last week, actually. So this is the US dollar Japanese yen. See this lovely big movement here, okay? And next to it is the British pound Japanese yen. Now, what happened on this big move here? This was on the 14th, so the 14th of February, okay? US retail sales came in at a negative of minus 1.2%, a lot lower than expected. So, of course, the dollar weakened against the Japanese yen. Now, this is US data, okay, US data. So really, it shouldn't really be affecting the British pound. But the British pound Japanese yen also collapsed, okay, or the pound collapsed against the Japanese yen. Why? Because, of course, if the yen is being bought up against the dollar, there's more activity in the yen, so more people are buying the yen, and that has an impact on other currencies, i.e. like the British pound. So as you can see, it's sort of mirrored the movement there of the dollar yen, again giving it quite a nice little movement there. But this is why the pound was also affected against the yen due to US data. Let's do another example. And this is very interesting pair. This is the Canadian Japanese yen, because obviously, as we know, as I already said, the US dollar, Canadian dollar is a commodity currency. The CAD is a commodity currency. Why? Because obviously Canada produces a lot of oil, so it's affected by oil prices. And Japan imports a lot of oil of their own, obviously, because they've got a steady industry, etc. So this is the movement, of course, on the back of oil prices, okay? As you see, the big drop in the Canadian dollar against the yen mirrors the drop in oil prices. However, as you can see, as oil prices started to rise, so did the Canadian dollar against the Japanese yen. Okay, so again, it's understanding these links between all the different types of assets out there and understanding the relationship. And here's another thing. This is how you can use the crosses to understand the majors. And I've got a little story to tell you to highlight this. Again, this is what happened on the 14th, the US data. Okay, so we've got the British pound US dollar, so the cable. We have the euro dollar, and I brought it the euro sterling. Now, like we said, retail sales came in negative at minus 1.2. So the pound initially got stronger against the dollar. But as you can see, that's not a massive movement. At the same time, the euro got stronger against the USD because of that negative data from the United States. And this time it was a lot bigger movement. So why did the pound move high and the euro moved high, but the euro moved higher than the pound did? Simple. Because at this current time, the euro was rising against the pound, weakening the pound. So this is why the euro movement against the dollar on this data was bigger than the movement of the pound against the dollar on this data. Again, it's dealing with the crosses, understanding why this is happening. And here's a story underlying this fact, okay? So let me tell you a story. Let's imagine, right? The US non-farm payroll comes in higher than expected, say at 356,000 versus 87,000 expected. Big number, right? So the dollar skyrockets against the Japanese yen. Same time, the euro dollar collapses. But here's the thing, what you noticed is, say the euro is not falling so heavily against the US dollar, the same as the dollar against the yen. It's skyrocketing because it makes sense. If the dollar is getting stronger against the yen, shouldn't the dollar get a lot stronger against the euro as well? Because it's good information, right? No. The reason why before the euro against the dollar, or dollar strength against the euro, is limited is because the euro yen, because the yen is being sold off heavily, is also being sold off against the euro, weakening the euro's downward, or protecting the euro's downward trajectory against the dollar. You see, because it's all linked. Up and coming future educational events. My last one for the month is, of course, the 26th of February. It's a lot longer than this one. This one's a short one today. This is how I got to understand the Elliott wave theory, which is one of my favorites, actually. It's great. I love that theory. And if you wish to speak to me, by all means, you can email me at james@strattonmarkets.com, or indeed follow me on Twitter or direct message me on Twitter. Before I go to any questions, again, I've been talking about online trading and CFD trading. Remember, like all types of investments, it does indeed carry a great deal of risk. I do suggest you do your own research and your own due diligence and know the risks at hand before entering any trade. With that out of the way, is there any questions at all? Anybody like to ask me anything? Any questions at all? No questions? Did anybody just enjoy it? Find it interesting, insightful? Okay, thank you, Robert. You did. Okay. Okay. Well, like I say, it's a very short one today because I'm traveling today. So it's a short webinar. What I would like to say, if you do have any questions you can think of later, or if you have any topics you'd like me to cover in the future, please feel free to email me. Let me know. Perhaps you'd like me to do a case study, I don't know, on the Aussie Kiwi, for example. That's a good currency. That's interesting. I'd like to talk about that one day. Or anything like that. Like I say, feel free to drop me a line and let me know. Till next week, thank you every single one of you for attending tonight. I really appreciate your time and listening to me. I hope you found it interesting and insightful. So till next time, can I say to every single one of you, depending where you are around the world, either a good morning, good afternoon, or even a good evening, depending where you are around the world. Till next time, every single one of you, trade safe.